Welcome back to my channel. In this video, I'll be explaining the algorithmic principles behind why I was bullish on Euro USD here, why price did not move lower to take out these low resistance before moving higher. I'll also be explaining the certain low probability conditions you need to avoid and when you need to trade. So let's get into this set of price action right here. If you're a novice trader, you would mark out these lows and you would expect price to move lower, take all your liquidity residing here, and then move higher. That is what is textbook, but there are certain conditions where price will leave the liquidity pools here and prefer to move higher. So when are these conditions present and when does price like to do this? So first thing to note is on institutional basis, which is on the monthly, weekly, and daily time frame, we are bullish. And when we are bullish, we want to see highs get broken and lows stay intact. This is also the reason why we see these lows intact and price does not move lower to take out the liquidity which resides here. You can see we have a clear bullish order flow. So these lows will remain intact, these highs will be taken. And this is this high right here. This low is this one right here. When price gets here, considering this dealing range, we have filled the gap right here. And once price moves lower or shows willingness to move higher through a small form of displacement, which is this low to this high right here, we confirm that a bias is going to be bullish and we want to see higher prices. And higher prices to where? To this specific high. Okay. We can also see that price took out these equal lows here, closed bullish, giving us another confirmation and a new invalidation point. Then price starts consolidating here, and Monday is when the new weekly candle opens. And as a trader who has been in this markets for more than 5 years, I always like to visualize the weekly open, low, high, and close. So I was bullish, price moved lower, took out Monday's low. And this is an algorithmic principle in and of itself. So once price takes out Monday's low and shows clear willingness to move higher, it does not need to come lower to take out these resting liquidity pools. Once price does that, we look to trade the next day, which is Wednesday, where price opens, moves lower, forms the low of this wick here, and moves higher, targeting previous week's high. Thursday, we opened and smashed higher to our major buy side liquidity, which is this level right here. Almost everyone on Twitter was bearish because they looked at these lows and considered them to be equal lows and expected price to move lower. We need to have clear context in price before we look to trade. Anyone can spot or mark levels which are equal lows, equal highs, fair value gaps, order blocks, you can name it. But if you do not have the right context and the narrative behind why price wants to do something, the algorithmic principles backing the exact narrative, you will not be successful. You will always be confused as to why price did this and that. You have no idea or explanation as to why price did that as well, and eventually you quit. So you need to understand that narrative and context is what's really important. Then you can use your algorithmic principles, you can use your fair value gaps, you can use your order blocks to confirm that narrative, right? So this is also the reason why it's a well-known fact that the entry model in your trading plan is the least of your concerns. Everyone focuses on the entry model rather than understanding the narrative and the context behind it. And with the right narrative and context, any entry model works. So you don't need to worry about entering on a fair value gap or entering on an order block, right? So let's discuss when these low probability conditions forms in price and when you need to avoid trading. First and foremost, and this is a really simple one, if the daily chart, which is this one, is not clear, you do not trade. It's as simple as that. So let's just say price was right here on Thursday, right? Wednesday, we have taken out Monday's and Tuesday's high, closed bearish. Thursday, we have two-sided framework. So we have this high here and we have this low here. We cannot target this low because we are bullish biased on the daily time frame and we have filled the fair value gap. So this remains a protected low. We cannot target this high as well because it has taken previous day's highs and closed bearish. So Thursday will be a low probability day. And this is the day you avoid trading. Okay. Friday, price takes out Wednesday's low and Thursday's low. You don't have a trade there as well. On Monday, you can see we have confirmed the narrative that we are going to be bullish because you've taken out lows here and rejected off of it. When Monday confirms that, Tuesday, you have a very high probability trade. Once price opens and moves lower, you look for your entry framework there. You get in a long position and you target Monday's high. It's not reached on Tuesday, but Wednesday does. And this is how you trade, and this is how you make sure that the daily time frame is aligned with your bias. If the daily time frame is unclear, you don't trade at all. This is one of the easiest ways where you can decide when and when not to trade, and you will not be glued to your screen waiting for setups and forcing setups as well. Another way where you can avoid low probability trade conditions is a simple one, which is if you do not have a fair value gap present, you don't trade. Let's consider price action from this swing point. Price moved lower, change in state of delivery below these up close candles. So we have that right here. Right? Just keep it here. Is there a fair value gap in the swing point from here to here? Yes, we do. We have one right here. So this fair value gap gives you high probability conditions. Without this fair value gap, you do not trade. Now, this fair value gap is present. So it was made on a Wednesday. Thursday, the following day, you don't trade. Friday, did it reach the fair value gap? It did not. So you don't trade here as well. The following week on Monday, we repriced into the fair value gap. And this confirms your bearish bias that you want to see price move lower. And this is where the context is aligned with price action, we have equal lows present here and here as well. We also have a fair value gap here. So on the 28th of April, in the last week of April, you are going to be bearish biased, especially on Tuesday. And once price starts moving lower, you can see targeted all these low resistance liquidity residing here. And we also have another fair value gap. You can mark out this fair value gap here as well and wait for price to return into it. We did that on a Friday, but we have already moved lower, taking and forming the weekly range, right? Taken liquidity and we've formed the weekly range as well. So we wait for the following week. Monday consolidates, Tuesday price moves higher, closes this gap once again, and Wednesday we start moving lower. And your bias for the week again is bearish. We have a fair value gap, so we have a bias. Price moves lower, fills the gap. Once it fills it, you have to keep in mind that on the daily time frame we're still bullish. Hence, we do not trade and wait for price to develop, right? And when did price actually do that? Right here. We have a change in state of delivery here on this candle. Price moves higher. We don't have a clear fair value gap. We had one right here, but this would be in extreme premium, so you would not be trading here. Wait for price to take out a liquidity pool, which is here. Close bullish, and then you wait for a clear fair value gap. We can see here that we have a balanced price range. So once price closes above it and validates it here on this candle, a return into that is your chance to go long. Following the institutional order flow, we have moved up higher, taking out buy side liquidity. So it can be really simple, but following the institutional order flow is really important, and understanding the narrative and the context behind why price moves, why it needs to go to a particular level is more important than anything you will witness in technical analysis. I did provide most of these information and teach in my university, which you can find linked below. I will see you all in the next video. Take care.